forward. Let's get some more investor perspective and reaction to this inflation report. Joining us here in studio, Lesley Marks, Chief Investment Officer at Mackenzie Investments. Good to see you.
Good morning.
Progress being made, in your opinion, on the inflation fight?
Yes, absolutely. I mean, I think that this actually really does open the door for the Bank of Canada to move ahead of the Federal Reserve. I think it's interesting to see that we could actually see a diversion in policy. And, you know, when you look at our economy, it certainly would justify, given the slowdown that we're experiencing, which is a very different environment than they're experiencing in the United States, it opens the door for the Bank of Canada. And
the concern being that, you know, when we talked about the components of inflation that are still, I guess, the sore spots, mortgage interest costs, rent, things that are byproducts of the fact that interest rates went up. But given the debt loads in this country, is that what you're referencing, sort of the difference between our economy and their economy?
Absolutely. I mean, the Canadian economy is much more interest sensitive, and has shown that versus the U.S., given the propensity for people to have variable rate mortgages here. And in the last Bank of Canada monetary policy report, Tiff Macklem talked about the expectation of the economy improving in the second half of this year. Well, on what basis? I mean, the only basis could be a change in policy related to interest rates, which would then filter into mortgage rates. When you look at the CPI numbers, obviously shelter is still sticky. We have an undersupply problem. The level of immigration in the country has been much greater than the plan for immigration, and so we certainly don't have the housing supply to support those numbers. But that doesn't change the fact that the economy is really suffering here in comparison to our neighbors to the south.
So if the takeaway from this inflation report is that we might see interest rate cuts in Canada sooner than people had thought, maybe as of Friday, and maybe prior to the U.S. Federal Reserve pulling the trigger on a redirect on interest rates, what's your current thinking about how much interest rate cutting we could see this year from the Bank of Canada? Because there's been a lot of debate around that.
Well, when you think about what got priced into the market sort of in that late October, early November period, we very quickly, by December, went to 150 basis points of cuts expected both here and in the U.S. In fact, in the early days, people thought Bank of Canada would move more slowly because of what you mentioned and your prior guest mentioned around the risk with housing. And we don't want to see the housing market explode from a price landscape. So now we've completely changed, and the market has kind of moved more towards what the Fed guidance has been, which was 3 rate cuts, 75 basis points. I think the current pricing is in that sort of 3 to 4 cut range. So we've really taken expectations back, and I think the same has happened here in Canada. So we still believe in the 3 to 4 range. It's just the pace and the timing, and we think that the Bank of Canada has the window to probably move a little bit earlier than the Federal Reserve, based on economic growth, CPI. I mean, you talk about data, you think about, we often label data as signal and noise. This was a very strong signal. It was that key important data point before the next meeting. It'll be interesting to hear how the Bank of Canada takes this data point and talks about it as a signal rather than just noise, because I think it's a pretty strong signal.
Yeah, great points. Okay, Lesley, stick around. We're going to chat a little